Welcome to another episode of YP Investors Quick Tips. In this episode, we'll be going over how to generate income from selling calls. Let's go over to YP Investors homepage. From here, make sure you're logged in, and then let's go to the Tools tab. Scroll down to the top stocks and sector ETFs. And this particular week, let's go with the number one stock, AGI. We're going to look at how to generate income from selling a call. Now, if you look back at a previous episode, you're going to see we just went over how to generate income from selling puts. Now, if you sold a put, that means there was a certain strike price, and if the price of the stock ended up below that strike price, then you probably got assigned to buy that stock. So let's say you own the stock now, or you just bought it outright and you own the stock. Either way, you're going to need at least 100 shares because there's 100 shares per contract in order to sell a call. So let's say we have 500 shares of AGI, and we're kind of nervous because let's say the market might be turning bad, or we heard some news, the Fed might not cut rates, or the Fed's going to raise rates, or there might be some tariff taxes. Anyways, anything that can cause the stock price to go down, we want to obviously preserve our cash and our investment. And a good way to, instead of just selling the stock outright, is to sell a call. So selling a call means you have to own the shares of the stock, and so we own 500, so we can sell 5 contracts. And let's say we want to sell the call at $7 because right now it's at $7.09. So that means anytime above 7 before the contract ends, our shares can get called out, and whoever owns those contracts on the other side, whoever bought the calls, can call them and buy the stock at $7. Now these are going to be pretty good premiums because whenever you are selling a call and it's below the strike price is below the current price, you're going to get a pretty good premium. So let's say we get $100 per contract, $1 per stock premium. So that means we have 5 contracts. 100 times 5 is 500. So we're going to get $500 just to sell this call. Now this means if this week, and let's say this call ends at the end of this week. So at the end of this week, if the price, or any time during this week, if the price is above $7, all our 500 shares could get sold at $7 each, because that is the strike price. And the caller, or the person that bought the call, has the right to do that until the contract is expired. And usually, if it's above the strike price, you're not going to get your shares called until towards the end of the contract. So by the end of the week, if it does expire above, our shares will be sold at $7 each. So you also, you want to make sure you know when you bought in, where you bought in. Make sure you're not selling it. If you bought in at $7.50, you're not selling it at $7. You might as well hold it a little while longer if it's a good positive technical stock like this AGI is. So let's get back to our example now. If we did in fact have sold 5 call options, and at the end of the week the price of AGI went down below 7, well, we just get to keep the $500 and we don't have to sell our shares. So we just made $500 extra just for having the risk, or the option for the buyer of the call contract to call the shares or purchase them at $7 a share. They don't have the right to purchase them at $7 a share if the share price is lower than the current price. And they can buy them, but why would they if the price of the stock is actually less than $7? Why would they pay $7 for share? Which is why the contract expires, and you just get the $500 premium. So this is a great way to protect yourself when you think maybe the the AGI is peaked out here, might retreat into a call of O's for a little bit. So one way to protect yourself and continue generate income is just selling calls on them. And what you want to do is maybe wait for a big day. Let's see, last Friday there wasn't much movement with this price, but maybe if the stock price goes up 2 or 3%, that'd be a good day to sell the call, because those premiums are going to be worth a lot more money when the stock, underlying stock, is going up. And you'd want to then, the stock price might be at $8 at that time, so then you could sell like a $750 call, and then you get more premium and you get more cushion and you get more gains on your actual underlying investment. Because if we bought in at $6, you're going to be selling it for $1.50 versus just $1 profit per share. So these are all things to think about, but this is a very good strategy for generating extra income, because typically the stock price is going to stay bound within these price ranges. So why not sell a call and continue to just increase those call sells, as long as you don't get assigned and they don't take your shares away. Just continue increasing it, and that's like a dual profit way. You can make money each week or month, and then you can also ride the stock up as it continues slowly to trend up. So our YP quick tip for you today is to sell a call on some of your stocks that you own and try generating some extra income. Try the strategy out, and we hope it works out for you and you continue to grow your wealth. Thanks for joining us today.